What if I told you that the same market conditions that terrified investors in 2000 and 2008 are setting up right now? But this time, 7 specific stocks could not only protect your portfolio but potentially double your money while others panic. Welcome to Next Wave Investing. I'm your host, and today we're diving deep into the 7 stocks that have the rare combination of crash resistance and explosive upside potential for 2026. We're going to break down the actual fundamental metrics, technical setups, and most importantly, why these stocks work in both bull and bear markets. So if you're tired of losing sleep over your portfolio, stick around. This could be the most important 15 minutes of your investing year. Before we jump in, quick legal disclaimer. I'm not a financial advisor, and nothing in this video constitutes financial advice. I'm a market analyst sharing research and educational content. Every stock mentioned carries risk, including the risk of total loss. Past performance doesn't guarantee future results. You should always do your own research and consider consulting with a licensed financial professional before making any investment decisions. The stocks discussed are based on my analysis as of late January 2026, and market conditions can change rapidly. Here's what's happening right now that 90% of investors are completely missing. The S&P 500 is trading around 6,850 as of late January 2026. On the surface, that looks fantastic. We're near all-time highs, but when you peel back the layers, there are serious warning signs flashing. First, valuations. The current Shiller PE ratio is sitting above 35. That's elevated by historical standards. We've only seen valuations this high during the dot-com bubble and right before recent corrections. Second, concentration risk is off the charts. The Magnificent 7 tech stocks now represent roughly 30% of the entire S&P 500's market cap. 7 companies, 30% of the index. When these stocks sneeze, the whole market catches a cold. Third, the S&P 500's 200-day moving average is currently around 5,900. We're trading about 16% above that level, showing we're extended, but there are reasons to be invested. The U.S. economy is still showing resilience. Fourth quarter 2024 GDP growth came in stronger than expected. Corporate earnings have been solid. The Federal Reserve has indicated a more accommodative stance after their rate cuts in 2024, which is supportive for equities. Here's the trillion-dollar question. How do you position yourself to capture upside in a market that could also correct 20 to 30% at any moment? This is where strategic stock selection becomes everything. We need stocks with 3 specific characteristics. Number 1, strong balance sheets with low debt and high cash reserves. Number 2, essential products or services that people must use regardless of economic conditions. Number 3, technical setups that show institutional accumulation, not retail FOMO buying at the top. The 7 stocks I'm about to reveal check all these boxes. They're positioned in sectors that tend to outperform or remain stable during market volatility: healthcare, utilities, consumer staples, technology infrastructure, and financial services. These stocks could realistically double from current levels over the next 12 to 24 months while giving you downside protection if the market rolls over. Before we reveal these names, if you're finding value in this analysis, smash that like button and subscribe to Next Wave Investing. Alright, let's get into the stocks. Our first stock is Eli Lilly, trading around $1,000 to $1,050 per share with a market cap of approximately $820 to $850 billion. The company's GLP-1 drugs, Mounjaro for diabetes and Zepbound for weight loss, are absolute blockbusters revolutionizing treatment for type 2 diabetes and obesity, which affect over 100 million Americans. Analysts are projecting 2025 revenue around $56 to $58 billion, up from approximately $34 billion in 2024. That's 65 to 70% year-over-year growth. EPS estimates for 2025 are around $18 to $19, putting the forward pay around 45 to 48 times earnings. Projected 2026 earnings of $27 to $30 per share bring the pay to the low 30s. They have approximately $7 billion in cash, $22 billion in debt, and generate over $8 billion in annual free cash flow. Technically, Eli Lilly consolidated in the $1,000 to $1,050 range after a massive 2024 run. The stock holds above its 50-day moving average with institutional accumulation on dips. The 200-day moving average around $780 provides strong support. The GLP-1 market is projected to reach $150 to $200 billion globally by 2030, and Eli Lilly dominates this market. This is recession-resistant. People don't stop taking life-changing medications because the stock market drops. Pros include market-leading GLP-1 franchise, exceptional growth, strong pipeline, and recession resistance. Cons are elevated valuation, competition from Novo Nordisk, regulatory risks, and manufacturing constraints. Our second stock is NextEra Energy, the world's largest producer of renewable energy from wind and solar. trading around $75 to $80 with a market cap of approximately $155 billion and dividend yield around 2.8 to 3.0% with 10-year history of 10% plus annual dividend growth. Revenue is expected around $25 to $26 billion for 2025. Projected EPS is $3.30 to 3.40, giving a forward pay around 22 to 23 times earnings. The company has $65 billion in debt with a debt-to-EBITDA ratio around 4.5 times. Standard for utilities, the stock has formed a multi-year base between $70 and $82, showing accumulation. Volume analysis shows institutional buying, and it's setting up for a potential breakout above $80, targeting $90 to $100. Utilities are the defensive sector in market crashes. During 2008, utilities were down only 30% versus 57% for the S&P 500. NextEra is investing $75 billion from 2024 to 2027 in renewable energy infrastructure. AI data centers need massive power, and NextEra is positioned to supply it. Pros include best-in-class renewable operator, stable utility cash flow, growing dividend, and defensive characteristics. Cons are interest rate sensitivity, significant debt, regulatory risks, and slower growth in tech and bull markets. Our third stock is Visa, operating the world's largest electronic payment network, processing over 270 billion transactions annually, trading around $315 to $325 with market cap of approximately $640 billion. They don't lend money or take credit risk, they simply process transactions. Revenue is projected around $36 to $37 billion for fiscal 2025 with net margin of 51 to 52%. EPS expected around $10.20 to 10.50, giving forward pay around 30-31 times earnings. Balance sheet shows $18 billion in cash, only $20 billion in debt, and debt to equity under 0.50. Visa consolidated in the $280 to $330 range, holding above its 200-day moving average around $290. A breakout above $330 targets $375 to $400 over 12 months. Visa is the ultimate pick-and-shovel play on global commerce. In recession or boom, Visa processes transactions. We're in early innings of the global shift from cash to digital payments. Pros include dominant network effect, exceptional margins, minimal credit risk, and recession resistance. Cons include regulatory scrutiny, fintech competition, and currency fluctuation impacts. Our fourth stock is Costco, trading around $950 to $980 with market cap approaching $420 billion. They operate 880-plus warehouses and make real profit from membership fees. 74 million paid household memberships paying $60 to $120 annually, generating $4+ billion in nearly 100% margin recurring revenue. Revenue projected around $260 to $265 billion for fiscal 2025. EPs expected around $16.50 to 17.00, giving forward pay around 56 to 58 times earnings. Balance sheet shows $13 billion in cash and $6 billion in debt. The stock has run from $450 to nearly $1,000 over 2 years. Technical setup suggests $1,100 to $1,200 is achievable over 12 to 18 months, especially with a membership fee increase due. In recession, consumers trade down to value. Costco is value. During 2008, Costco's same-store sales remained positive while competitors cratered. 92% renewal rate shows cult-like loyalty. Pros include unique membership model, recession-resistant behavior, international expansion, and fortress balance sheet. Cons are expensive valuation, low margins, and e-commerce competition. Our fifth stock is Microsoft, trading around $440 to $450 with market cap of approximately $3.3 trillion. Revenue projected around $270 to $275 billion for fiscal 2025. Cloud revenue from Azure, Microsoft 365, and Dynamics exceeds $150 billion annually, growing 25% plus. EPS expected around $13.50 to 14.00, giving forward pay around 31 to 32 times earnings. Balance sheet shows $80 billion in cash and $75 billion in debt. 70% plus of revenue is recurring subscription-based. Companies don't cancel essential cloud infrastructure in recessions. Microsoft consolidated in $420 to $465 range, setting up a bullish flag pattern. Support at 200-day moving average around $410 looks strong. Breakout above $465 targets $525 to $550. They own 49% of OpenAI and have integrated AI across their product portfolio. Even without AI, they have Windows, Office, LinkedIn, Xbox, and Azure. Trading at 31 times forward earnings with 15 to 18% expected growth gives PEG ratio around 1.8. Pros include diversified revenue, AI leadership, recurring subscriptions, and exceptional balance sheet. Cons are large market cap limiting upside, antitrust scrutiny, and dependency on enterprise spending. Our sixth stock is UnitedHealth Group, trading around $300 to $400 with market cap of approximately $505 billion. They operate United Healthcare Insurance for 53+ million people and Optum Healthcare Services. Revenue projected around $415 to $420 billion for 2025. EPS expected around $30 to $31, giving forward pay around 18 to 19 times earnings. Balance sheet shows $25 billion in cash and $77 billion in debt. UnitedHealth has grown EPS at 13 to 15% annually for over a decade. The stock corrected from 2024 highs around $630, finding support in the $520 to $540 zone. Recovery to $650 to $700 represents 20 to 25% upside. Healthcare is the most defensive sector. People don't cancel health insurance because the S&P drops. America's healthcare spending projected to grow from $4.5 trillion to $6+ trillion by 2030. Aging demographics create massive tailwind for Medicare Advantage. Pros include recession-proof model, diversified revenue, Medicare growth, and reasonable valuation. Cons are political risks, regulatory scrutiny, margin pressure, and complex business model. Our seventh stock is Procter Gamble, trading around $140 to $160 with market cap of approximately $405 billion. They own 65 brands generating $1+ billion each annually. Tide, Pampers, Gillette, Crest, Charmin, Bounty. Revenue expected around $84 to $85 billion for fiscal 2025, with net margin of 17 to 18%. EPS projected around $6.60 to $6.80, giving forward pay around 25 to 26 times earnings. Dividend yield is 2.4% with 68 consecutive years of increases. Dividend king status. Balance sheet shows $7 billion cash and $34 billion debt. The stock consolidated in $160 to $180 range, holding above 200-day moving average around $165. Technical setup suggests $190 to $200 achievable over 12 to 18 months. In 2008, consumer staples fell only 13% while S&P dropped 37%. People still brush teeth, do laundry, and buy diapers in recessions. With 5 to 7% annual appreciation, 2.4% dividend, and dividend growth over 3 to 5 years, total returns could approach 100%. Pros include essential products, massive moats, 68 years of dividend increases, and pricing power. Cons are limited growth, currency headwinds, private label competition, and premium valuation. Here's how to build a portfolio with these stocks. Tier 1, core defensive holdings at 40%, NextEra Energy, Costco, Procter Gamble. In a 20 to 30% market correction, these might drop only 10 to 15%. Tier 2, growth with protection at 35%, Eli Lilly, Microsoft, UnitedHealth. Tier 3, high-quality cyclical at 25%, Visa. Could these double? Realistically, Eli Lilly could reach $1,600 to $1,800 in 24 to 36 months, 100% plus return. Microsoft could reach $800 to $900 in 36 months. Visa $600 to $650 in 36 to 48 months. NextEra, Costco, UnitedHealth, and Procter Gamble more likely see 50 to 80% gains over 3 to 5 years plus dividends. But if the market drops 30%, this portfolio might drop only 10 to 15%. That downside protection is worth more than speculative doubles. Never put all your money in any single stock. Diversification beyond equities is crucial. Consider dollar cost averaging. The market can remain irrational longer than you can remain solvent. Have a 3 to 5 year time horizon minimum. If this analysis provided value, hit that like button. Subscribe to Next Wave Investing and turn on notifications. We publish deep dive stock analysis every week. Drop a comment with which stock you found most interesting. Share this video with one person who needs to see it. Remember, the best investors don't just survive market crashes, they position themselves to thrive on the other side. These 7 stocks give you that positioning. Until next time, this is Next Wave Investing. Stay informed, stay disciplined, and I'll see you in the next video.